All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.
Hi, everybody. Welcome to episode 28 of the Macro Corner podcast, proudly presented by Blue Line Futures. I'm your host, Paul Wankmueller, my co-host, the one and only Jannis Meindl. Welcome to the show, Jannis.
Hey, Paul. Great to be back on the podcast. Lots to cover on the back of a lot of central bank talk last week.
Absolutely. Last week was very, very busy. We had CPI, and then we had the Fed meeting, which Jerome Powell gave his speech. They clearly raised 50 basis points. Everyone knew that was coming. But the rhetoric after that is what we all pay attention to. But let's start off with that CPI. It came in a little bit less than hot, but what were the components that you saw were sticky? How'd you dissect that one?
Yeah, so largely echoing what happened the week before in PPI, which was the Friday prior to the CPI report, was that food stayed relatively sticky. Food at home was the one that contributed about 1% to headline CPI, which was at 7.1. We had also energy continuing to be a substantial disinflation driver within CPI. When we look back earlier this year in June, energy contributed more than 3% to headline inflation. That was down to 1% in the November print. So that's a substantial disinflationary force and one to watch as we see what happens in and around oil prices that also affect gasoline and such. And then we have some of the more pandemic related components like used cars and trucks that really were buoyed by the fact that there were a lot of clogged supply chains, and that was one of the components that actually acted on the deflationary side, detracting about 0.1% from headline CPI. And then of course we have a substantial driver still of inflation, but as the Fed is pointing us towards more real-time indicators, we still have the shelter component, one to watch going forward, that contributed OER, which is owner's equivalent rent. That's just an estimate of what homeowners would rent their home for if they were to do so. That contributed 1.7% to headline, and then rent as also a lagging component contributed about 0.6 to headline.
Just want to touch on that for one moment, just to clarify. So that would say, if I was spending $3,000 on my mortgage, that's what I would spend on rent.
It more precisely measures how much a homeowner would rent their home for, and the relative change on a yearly basis of that. So if you own a home, if you were to rent that home to someone else, right, what is that number? And that's of course an index. It's not like the U.S. Bureau of Labor Statistics,
right?
That is goes in and counts every single home into dollar terms. It's just an aggregate change.
Well, that's a great way to lead into Jerome Powell's speech after the Wednesday meeting, again, the Federal Reserve meeting. So he decided to split inflation into categories in his rhetoric. You want to go a little bit into that?
Yeah, exactly. That's what we saw during his speech at the Brookings Institute, which was before the Fed meeting, where he really dissected inflation into a couple of components because he and everybody else understands that there are lead-lag relationships. So the first component that is roughly unfolding the way that the Fed expected it would because of getting really buoyed during COVID and the spending around COVID, which is the durables component of CPI. That has inflated a great extent up to a little bit below 20% on a year-on-year comparison before the recent cooling off. So durable goods are behaving as expected or cooling substantially. The next component that he mentioned is the CPI housing component. So one of the themes that we've talked about in the past extensively is the fact that OER, owner's equivalent rent, and rent in general of different real estate, that component is a lagging indicator. So as the Fed has realized that, and as that rent component, that shelter component will continue to put upward pressure on CPI, they've guided the market towards more real-time indicators of rent. And even looking at some of the publicly listed REITs out there, we do see that these investors are definitely expecting rents to have come off substantially,
Right.
and so CPI unfold as expected. The last component that the Fed is putting more emphasis on and that they seem to be most focused on here is the CPI core, excluding the shelter component of CPI. So, and that part is specifically made up of services, and those services are mainly driven by wage dynamics. So, as we've seen a lot of strong wage growth, as especially the job switchers who fill jobs that nobody else wants to fill, as those are the people who are getting the increases, we do see that the Fed is more cognizant of those wage dynamics. We saw news that Spirit Airlines is actually increasing wages over the next 2 years by up to 43%. So those wage increases are definitely quite steep. And that's one of the aspects that the Fed is most focused on. So Jay Powell gave us a little bit more guidance in terms of what they're watching.
Right. And in turn, we've spoken about this on previous podcasts, how you really don't want to see that spiral, that wage spiral, where it can come back to, well, the companies are going to have to charge more money because they are paying their employees more.
That's exactly it. I mean, this is sort of the slow but steady inflation dynamic where you have the one aspect increases and the other aspect increases, and it sort of goes back and forth. But the Fed doesn't want to see that, especially as wage increases might start to outpace the inflation itself starting next year. I mean, these are then real wage gains, and what we've seen in the past have been real negative wages. So as inflation was rampant and wages didn't quite keep up, we saw negative real wages. And wage negotiations unfold over a long time period. It's not like you go to your employer and renegotiate wages each week as you see a new economic number drop. So that's also one of the reasons why that component might be a lot more sticky. It's because these wage negotiations, similar to the resetting of rents, those are all components of the economy that take time, and that's why the Fed is watching them.
Right. Yeah. I mean, financial conditions are the channels in which the economy is affected.
Yeah, that was definitely another aspect of Jay Powell's speech there on Wednesday, which was he made it clear that the channel through which the Fed affects the economy is financial conditions, and we have seen some easing of those conditions. I mean, that's mainly a result of bonds rallying to an extent. We have seen stocks rally. We've seen the dollar sell off. So those are all contributors to easier financial conditions. But that's a channel through which they affect the economy. And if those continue to cool and if those continue to ease, then it would not be a surprise for the Fed to put a little bit more emphasis on higher for longer going forward.
Sure. Well, I mean, after everything that's gone on this year, we still do have strong retail sales. I mean, today we had Nike come out. They did very, very well on their earnings. And, the stock was up pretty good. I think it was up about 15% today. So, where do you think that's going to be going? Because you got to remember, we did have an excess of savings over the past 2 years, during COVID, et cetera. And are people just running through those savings? Do you think this can continue, or where do you see that one going?
I think this is one of the major things to watch as inflation cools off, and where is consumer activity and therefore economic activity going to be. We've talked about this extensively in the past, where we have excess savings because of all the transfer payments that we saw. Those excess savings are about $1.5 trillion higher than they were in Q4 of 2019. So there are still excess savings out there, and that's what's being reflected in earnings like Nike's today. And then we have a more real-time indicator of what consumer spending is doing, with retail sales still at nominally really strong levels. But yeah, I mean, the question is where it's going to go rather than where it's been. And it would be reasonable to assume some sort of cooling. one of the key themes that some research outlets have highlighted lately is that the fact that millennials in the economy are hitting peak spending years. So as that demographic is hitting peak spending, that will definitely propel economic activity to an extent and maybe not let the economy cool to the degree that one might think, given the cumulative effects of tightening. But we shall see. It will definitely be somewhat difficult to keep up current levels of spending just because how much excess savings we've seen and the fact that those are getting drained.
Sounds good. Sounds good. And, talking about expectations, the inflation expectations, I do see, I believe this might be chart 8 on our chart book here. We're looking at 5 to 10 years from now that inflation expectations might not be as bad as we think, and they might actually return to pre-COVID levels.
Yeah, so one of the major aspects, and companies like Bridgewater have talked about that extensively, so I'm not the first person to bring that up, but we're ultimately standing on the shoulders of giants here. And one of the key themes, I guess, going forward in all of macro and the way it's going to affect different asset classes in the years to where inflation is going to be and whether inflation expectations are ultimately going to adjust back to pre-COVID levels or whether they are going to be secularly at a higher rate. And what we see right now is that 5-year break-even inflation expectations and also 10-year break-even inflation expectations, those are sort of back at 2019, 2018 type levels. Okay. So what the market is telling us is that the market right now is saying we see inflation dynamics going forward more similar to what we had before all the supply chain crisis began, before Russia invaded Ukraine and therefore created more inflation. All these aspects, we expect them to return to normalized sort of levels. The question is, if we move from a dynamic where we have cyclical inflation concerns move towards more secular inflation concerns, where maybe deglobalization dynamics combined with a labor shortage, combined with a lack of productivity improvements, when all these factors come together and we take them combined, that would have us suggest that maybe inflation is a little bit higher on a secular basis. But the market right now is saying the opposite, and whether markets and asset classes in general will have to reprice to a higher level of inflation is definitely going to impact the way that investors see their assets holdings in terms of bonds or stocks or alternatives. The way that they pay off will definitely be impacted by the ways in which we see inflation expectations behave going forward.
Right. And I think one thing always to note is that it's very difficult to predict anything 5 to 10 years from now. So we will wait and we will watch and we will see.
Absolutely. This will be a real-time thing unfolding, and we'll have to take one piece of information at a time. We'll have to take anecdotal evidence and we'll put it all together in one big box and see how the big box is going to look at the end of the day.
Absolutely. Absolutely. Jannis, thank you so much. Always a pleasure. I wanted to wish our listeners and our guests a very, very Merry Christmas and happy holidays. And wanted to thank you, Jannis. This is one of the best gifts that you've given me was being my co-host on the show this year.
Thank you, Paul. It's been an absolute pleasure. It's hard to believe that we are on episode 28 today.
It's amazing.
But yeah, it's been a pleasure.
It's amazing. Well, everyone, don't forget the Blue Line Futures chart book is available in the description of the podcast on bluelinefutures.com, as well as attached to the email sent to clients every Sunday. Not a client? Reach out to podcast@bluelinefutures.com for a free 2-week trial of our premium research covering equity indices, bonds, metals, grains, seasonal trades, and more. Thank you, everybody. Have a great, great season, and we will see you soon.
All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.